After studying this module, you shall be able to know various types of decisions, understand the meaning of mutually exclusive projects, apply the different types of financial appraisal techniques, evaluate the projects for choosing the right project, identify the projects which can be taken up simultaneously. Capital is a limited resource and must be used efficiently and judiciously. Therefore, capital expenditure decisions demand careful thought and should be taken after considering various options. They are also long-term decisions, and if they go wrong, it will involve high cost and in fact they are difficult to reverse. When a capital expenditure decision is made, the investments are made in form of assets like land and building, plant and machinery, etc. These decisions are made or cash is expended because some future benefits are expected. These benefits generally extend beyond 1 year. Therefore, decisions should be taken only after comparing the various alternatives. Out of the different investment proposals available to the business, it has to choose a proposal that provides the best return, and the return should be at least greater than or equal to the return required by the investors from whom the capital is arranged. Thus, the whole process consists of evaluating investment project proposals that are strategic to business overall objectives, estimating and even evaluation post-tax incremental cash flows for each of the investment purposes, and selection of an investment proposal that maximizes the return to the investors. If a wrong decision is taken, it will be detrimental to the value of the organization over a long period of time. Now let us discuss about the types of decisions. There are various types of decisions which are to be taken while projects are undertaken. These decisions can be regarding a new undertaking or an existing undertaking. A new undertaking is confronted with the decision whether to start a project or not, where to locate the project, which machines should be installed, whether it is mutually exclusive project where only one of the projects can be chosen, or is it a capital rationing decision where many projects can be taken up simultaneously. It could also be a decision where there are simply no choices. The only decision to be taken is whether to accept the project or reject it. Similarly, an existing undertaking can be interested in finding whether to go for expansion or not. It has to choose whether to modernize the plant capacities or continue with the old system. Another decision taken up by an existing undertaking is when to replace its machineries. Various types of decisions that come up for a consideration may be summed up as follows. Number 1, accept and reject decisions. While considering a single project, sometimes the decision to be taken is whether the project should be accepted or not. There are no choices in the project and there is just one project which has to be evaluated. If the project gives positive result by using any of the techniques applied, the project is accepted, otherwise the project is rejected. There is no comparison regarding the choice of projects. These decisions occur when proposals are independent and do not compete with each other for the share of investment. The firm simply accepts or rejects the proposal on a basis of a minimum return on the required investment. All the proposals which give a higher return than certain desired rate of return are accepted and the rest are rejected. Let us take an example. A machine is available for purchase at cost of rupees 80,000. It is expected to have a life of 5 years with salvage value of rupees 10,000. The estimated profits before depreciation are as follows. The first year, the profits are 20,000, in second 40,000, third 30,000, fourth 15,000, and in the fifth year they are merely 5,000. Find whether the project should be undertaken or not if the average rate of return required is 15%. Ignore the taxes. Now let us come to its solution. We have the year, profit before depreciation, depreciation, profit after depreciation. Now look at this table. This table shows that the rate of return on average investment is equal to average profit divided by average investment multiplied by 100, which is equal to average profit divided by half of original investment plus salvage value multiplied by 100, which is equal to, in this example, 17.78%. Since 17.78% is higher than the required rate of 15%, therefore, the project should be accepted. Now let us come to mutually exclusive decisions. The decisions are said to be mutually exclusive if two or more alternatives are such that the acceptance of one proposal will exclude the acceptance of all others. Under mutually exclusive projects, only one project is undertaken. For example, if machine X is taken up, machine Y will not be installed, and if machine Y is undertaken, machine X cannot be installed. There is also a possibility that only project is to be selected out of many projects. These are also mutually exclusive projects where one of the many projects is undertaken. This implies that mutually exclusive projects are not necessarily a choice between two projects, as it can also be a choice of one amongst many. It may be possible that all the projects are otherwise attractive and viable, yet only one of the many can be taken up. These projects are appraised using any of the appraisal techniques, and the best of the option is selected. Sometimes the result can be conflicting under different techniques used. Let us take an example. A company is evaluating two independent proposals, that is project X and project Y. Now we have to find out, on basis of this given information, the discounted payback of both projects at the discount rate of 13%. Let us look at the solution of this problem in this table. In this table, discounted payback period of the project comes out to be 4.10 years with help of the given formula. While in case of project Y, this comes out to be 3.38 years. By evaluating the projects using discounted payback period, project Y should be installed. Now coming to another example, a company is considering purchase of either machine X or machine Y having these particulars. Now from this given information, calculate for the two machines the payback period and the net present value at 12% discount rate. The solution of this problem is given here. The payback period of machine X is equal to 3 years. Payback period of machine Y is equal to 3 years plus 6 upon 12 year, which is equal to 3.5 years. Now computing the NPV of machine X and machine Y. This information is given in this table. Now expansion decisions. Existing successful firms may experience growth in demand for their product, and in order to increase their market share and not lose it to the competitors, the firms may like to go for expansion. Whenever the firm faces the problem of not being able to meet its demand or delay in deliveries, inadequate production facilities, it resorts to expansion. It may decide to set up a new plant to increase its capacities, or may even undertake to set up a new site at other places. If the product has developed international reputation, the firm may also decide to set up operations in other countries. Expansion is riskier than replacement decisions. Then the fourth type is diversification decisions. Sometimes the reputation of a firm increases and its customers start demanding other products by the same firm. In such a case, the firm will have to go for diversification plans. The firms diversify into new product lines and maybe into new geographical areas. These are called as revenue expansion decisions. These decisions are very risky as the firm is trying to enter new area. In India, We say Tata Sons venturing into lot of areas, but it is not always necessary that if one is successful in one industry, it will be successful in all. An example of diversification would mean that a firm in fast moving consumable goods, that is FMCG industry, venturing into software industry. The fifth type is replacement decisions. Replacement decisions helps in determining whether existing machines should be replaced or not. What should be the timing of replacing the existing machines? Should they be replaced after completely being worn out, or should be scrapped a little earlier so that unnecessary cost and hassles of repairs is avoided? Another consideration is, should the replacement be to maintain the current level of operations, or should the machines be replaced with better technology and upgraded? In the light of all the above considerations, the replacement decisions become a little complicated affair in comparison to the other decisions. The following steps must be followed in taking up the replacement decisions. Step 1. Calculate the initial cash outflow due to the replacement. The original cost of new machine or equipment will be taken as the outflow, and any money recovered from the sale of old equipment and any taxes payable on the profit on sale of old equipment will be deducted, and if there are any losses on sale of old machinery, the tax savings will be added. Step 2. The second step will be to estimate the annual operating changes. The new equipment may generate additional income and may involve reduction in operating cost. This should be treated as inflows after adjusting for taxes. Further, while calculating operating incomes, the changes of depreciation after tax should also be considered. Step 3 will be to consider the changes in cash flow in the terminal year after tax. Step 4 will be to compute the present value of all the cash flows and then take the final decision whether to replace it or not. Accept the decision if present value of benefits are greater than the present value of cost. Now let us look at one example. WXY is a firm which is operating a machine that has a life of 3 years, and operating cost for the 3 years as well as the resale value at the end of each of the 3 years is given here. Find out when the machine should be replaced, assuming the cost of capital is 10% and cost of machine is 40,000. The solution of this problem is that if machine is replaced after first year, the NPV will be equal to minus 40,000 minus 18,000 multiplied by 0.909 plus 28,000 multiplied by 0.909, which will be equal to rupees minus 30,910. If the machine is replaced at the end of the second year, this NPV will be equal to minus 40,000 minus 18,000 multiplied by 0.909 minus 21,000 multiplied by 0.826 plus 23,000 multiplied by 0.826, which will be equal to rupees minus 54,710. Similarly, if the machine is replaced at the end of the third year, the NPV can be calculated, which will be equal to rupees minus 78,965. But these NPV are for unequal lives. Therefore, to find equated NPV, they should be divided by present value annuity factors at 10% for respective years. In the first year, it will be equal to 30,900 divided by 0.909, which will be equal to 34,004.40. In the second year, it will be equal to 54,710 divided by 1.735, which will be equal to about rupees 31,533. While in third year, it will be equal to 78,965 divided by 2.486, which will be equal to around 31,764 rupees. Therefore, the machine should be replaced after second year. The sixth type is capital rationing decisions. Capital is a limited resource and there may be many projects with positive NPV or profitability index greater than 1 or an IRR well above required return. But it will not be possible to invest in all of them together. A selection has to be made among various projects. The combination of projects is selected in such a manner that maximum profitability is received within specific limits. Capital rationing can be experienced due to external factors, namely imperfections in capital markets, investor attitude, etc. Internal capital rationing is due to self-imposed restrictions such as a person is not willing to raise debts or raising the level of return required from each project. The capital rationing may be introduced by authorizing a particular department in the organization to make investment up to specified limit beyond which the investment decision are to be taken up by the higher authorities. The selection of project under capital rationing involves two steps. Step 1. To identify the projects which can be accepted by using the techniques of evaluation. Step 2. To select the combination of projects. Now look at this example. A company is considering following 6 proposals. You are required to compute the profitability index of each project and rank them. Which project would you choose if total funds available are rupees 8,000? The solution is given in this table. If the total funds are restricted to rupees 8,000, the best combination of the projects is analyzed in the following table. The best combination is project 1, 2 and 6 as it gives the highest NPV of rupees 1,865. Now let us summarize what we have learnt from this module. To summarize, we can say that capital is a limited resource and must be used efficiently and judiciously. Out of different investment proposals available to the business, it has to choose a proposal that provides the best return, and the return should be at least greater than or equal to the return required by the investors from whom the capital is arranged. There are various types of decisions which are to be taken while projects are undertaken. These decisions can be regarding a new undertaking or an existing undertaking. Accept and reject decisions. These decisions occur when proposals are independent and do not compete with each other for the share of investment. Expansion decisions. Existing successful firms may experience growth in demand for their products, and in order to increase their market share and not lose it to the competitors, the firm may like to go for expansion. Diversification decision. Sometimes the reputation of a firm increases and its customers start demanding other products by the same firm. In such a case, the firm will have to go for diversification plans. Replacement decisions helps in determining whether existing machinery should be replaced or not. Capital rationing decisions. Capital is a limited resource and there may be many projects which are acceptable, but it will not be possible to invest in all of them together. A selection has to be made among various projects. The combination of projects is selected in such a manner that maximum profitability is received within specific limits.